Stronger economic data calms the markets, but will it last? Welcome to Market Insight. I'm Elena Casas. Wall Street has rebounded this week to leave the S&P 500 within about 2% of July's all-time closing high, after strong retail sales and lower inflation gave investors confidence that the US economy is on course for a soft landing. They're unwinding bets on a dramatic 50 basis point cut from the Fed in September, and the central bank's plans may become clearer next week when Chair Powell speaks at the Fed's annual economic policy symposium in Jackson Hole, Wyoming. Well, joining me now to talk about that and more is Youngyu Ma, Chief Investment Officer at BMO Wealth Management. Youngyu, welcome. Let's start with that then. What should investors look out for at Jackson Hole?
Yeah, thank you. Great to be here. We think at Jackson Hole, probably a lot of what the market is going to be keying off of is not just the Chairman Powell's discussion about what's going to happen with near-term Fed policy, but really more the medium term. What does he expect to happen in 2025 in the longer term, and where does he think those interest rates are going to settle when we get toward the end of next year even? We think that's going to be very important on investors' minds to understand the trajectory that the Fed has in mind. In addition to the short-term discussions that the Fed is having, more clarity on that. So we don't think there are going to be big policy shifts or signaling of major changes that the Fed is likely to make in terms of its overall thinking. We think it's more clarity along the path of interest rates is going to be important here.
I noticed you said in your notes that once the Fed starts to cut, the economy may react much more strongly and more quickly than it did to the hiking cycle. Why do you think that?
Well, we think there's a lot of pent-up demand. We think that is the case in the current scenario. There's the standard refrain that the Fed's either interest rate increases or cuts have long and variable lags. But that's just a rule of thumb. Actually, in this case, we think there's a lot of pent-up demand once we get maybe 0.75% of cumulative cuts or 1% of cumulative cuts. A lot of that pent-up demand, both by corporations and consumers, will start to kick in. So we think there's actually going to be quite a surprise that we see in the economy once interest rates are about 1% lower than they are today. And we're quite optimistic on 2025 because of that.
Is there a risk, though, that the backward-looking nature of the Fed's focus on the data means it gets left behind, as it did during the hiking cycle, and that demand isn't released?
Well, that's a great question. We do think the Fed is more backward-looking than is probably warranted at this point. The Fed calls that data dependency, but really data dependency can also include more forward-looking data as well. We think that could mean that the Fed gets a little bit behind the curve, but ultimately the path is still in place. And we think if the Fed does get behind the curve, it won't stay behind the curve for long. For example, if we were to see labor market weakness, we do think the Fed would react more aggressively than it's currently inclined to do. So we feel pretty comfortable. We could get some choppiness if that is the case, if the Fed seems to be behind the curve a bit. But overall, we think the Fed's ability to shift and be nimble is probably a bit more than the market gives it credit for at this point.
Markets, of course, are also digesting the earnings season. Hopes were so high, Youngyu, especially for AI-focused tech firms, and the reception of their numbers was a bit lackluster. What did you make of it?
It was lackluster. A lot was priced in going into the earnings season, and there were very high hopes. Earnings season was decent. It wasn't bad, but it wasn't a blockbuster earnings season. But when we look forward to the coming quarters, earnings growth continues to look healthy. We do think that AI spend and the overall technology spending and the technology being a driver in the economy, or the main driver even for earnings growth, we think that will continue and continue to be strong. We don't see any let up in spending. And we think that as we get into 2025, the story of AI benefits permeating the economy more broadly is going to be much more accepted and common, so that the general sense of the continuation and sustainability of the spending will probably be more believed in than it is or than it has been in previous weeks.
How do you think investors should be positioning themselves, though, at the moment, especially as we move into the final quarter of the year and, of course, the US election becomes imminent?
That's a great question, because we have had in the prior two election cycles in 2020 and 2016 a choppy couple of months before the elections. So September and October in those years were notably choppy and somewhat weak. We do think that could play out again because the Fed will only have just begun on its rate cutting campaign. It won't be as far along as we talked about that would set in motion that those economic surprises that we're expecting in 2025. We think it's a time to look for opportunities. It's not a time to be overly aggressive over the next couple of months, but it's a time, if we do get pullbacks the way we had a couple of weeks ago, to look for opportunities for positioning that investors might have cash on the sidelines are looking to bring in, or companies or sectors they're looking to invest in that they haven't had a chance to. So we think it's a time for that, opportunities, not to be scared away from the markets. If we do get a pullback, we don't think there's going to be meaningful downside momentum that's either building the economy or in the markets, and that should be something where investors look for opportunities.
Young-Yu Ma of BMO Wealth Management, thank you so much for that analysis. And that's Market Insight. Don't forget, you can watch more videos on Reuters.com.